All right, so last time we spoke about the supply line and a little bit about its relevance, but basically it is just another re-understanding of stage one, stage twos. Stage ones, stage twos, we already know this is how price generally moves. It's just the supply line now creates a better understanding of if the underlying stage one is worth following, if it's clean, if the supply that's coming in is minor, right? If the demand that's coming in is very, very large, and if it makes sense to continue following, right? So you have a market, maybe it moves into like some kind of accumulation MB, right? Moves much higher, maybe something like this, then has a candle, two, maybe three down on the validation time frame, looks something like this, right? You know that's already a stage one. It's very clear it's a stage one. Stage two is the next thing you'd suspect if it was to happen. Maybe it happens like this. Maybe it pauses again. Then it maybe goes for a very, very crazy move, something like that. Stage one, stage two, stage one, stage two is just that in this terms, the stage one of this validation time frame ends up being contained by the supply line or by the containment line. And that line allows us to understand where the accumulation is clearest to happen. Now, the reason this is such a powerful understanding is because at this point, what we've done is we've created just an overall move that basically defines moves in the markets. And you might actually notice that this is very familiar. A move up, some kind of move down, a move up, right? And if you, again, move up, a move down, a move up. And if you think back to our beginning principles of demand, of supply and demand and how it functions, what's ultimately happening is we are entering through this point here and we are looking to take that market higher, okay? But why is this such a powerful kind of understanding? Why does this work so well? What is the underlying kind of steps under it? And that is right here. So ultimately, it provides a framework for how moves develop. And this video alone should undo, if you've ever learned to trade anywhere else, should undo all poor initial understanding that you may have had about the market in any way prior, while giving you a true way to understand trends and follow them. So let's go to this specific area right here. And let's think about what we see here. So something you might notice off the bat is the stuff that you've went and experienced throughout the entire material so far, right? Overall demand validations, creating beautiful moves higher. Now, what you also see in this case here is you see an example and usage of the exact same supply line or containment channel, whatever you want to call it, doesn't really matter, but basically the containment line. And here it is. That's kind of that area, right? And you can imagine this as maybe a few candles down, something like this. Maybe it's 3 or 4, maybe something like this, right? 4 candles down, then you have this one, then you have this setup, or whatever it might be. So ultimately, what is happening here? Let's think about this from a perspective of orders. At first, I want to do it through this simple example, and then I want to show you what this looks like in terms of real markets, real thought processes, and where a lot of people go wrong, okay? So what you end up getting is some kind of stage 2 market. Move higher, right? Then you get your stage 1, then you get your next stage 2. So if I was to draw this out, stage 2, stage 1, right? Stage 2 in this case. And then maybe a stage 1 is next. I don't know, right? Maybe this goes sideways. Normal stage 1s, stage 2s, stage 1, stage 2s, stage 1s of the validation or context time frame on the momentum cycle will be helpfully refined and defined by the containment or supply line, which is right here. So that's that example of that stage 1 occurring. And then we're watching that for the purpose of getting involved, which is why we use the EVC. Right, but ultimately, stage 2 price moves higher, initial onslaught of buying, or there's buying that exists in the market. There's somebody basically pressing the buy button. So the composite operator is clearly behind this move. You have a pause of that, and what happens is you have sellers begin to come into the market. We've spoken about this over and over and over again. Those sellers come in such a way that doesn't allow the market to move substantially lower, and instead allows the market to be bought up at the rising 5, 10, or 20. So as selling comes in, new buying and the algorithms of buyers and the composite operator that might have either bought before or new components of the composite operator that now want to purchase start to repurchase the market and buy in. And as they buy in, you get a containment channel of that selling. The selling is not strong enough to create a completely dysfunctioning market where it's all over the place. The selling isn't enough to completely flush out the market and create a market that is no longer worth watching for the time being until it moves into a new stage one and then maybe starts to move later on, right? Instead, the selling is, as we can call it, just perfect enough. Or even better, the buying is just perfect enough because it wants to accumulate and eat up all those sell orders or all the selling that exists, start to reaccumulate and create bigger positions and buy into bigger positions because, well, it's the best time to do so for the purpose of being in on the next run. So supply starts coming into the market, and that supply sells down into the market. And then, as we've been through multiple times before, and as a lot of you should remember back from here, in terms of how does overall buying from supply happen in the market, right? You already have the demonstration or kind of the example of that, and you have the idea of the composite operator. So that's all worked out and all understood, right? So ultimately, what's happening now is that supply comes in, demand starts to eat up that supply, and as demand gets beyond the containment line or sets up that trade above the containment line, it runs and begins to run the initial supply buildup, basically fearing or scaring prior supply into stopping their positions out, into potentially even buying more sell orders to potentially try to get a better price and getting screwed over on them, while also beginning to create new sellers that want to start getting in because they start believing that the market may want to go lower or whatever, and creating new floating supply that, of course, is basically just like is useless supply. It's weak. It's extremely weak. And what happens is the underlying demand that has already bought into the initial positions, that has bought into these potential continuation positions, and is now accumulated, right? So think about this as like, if this was a lower time frame, maybe this is an MB1 and an MB2 of an E time frame. So if this was an E, if we scaled this up, maybe it was like a few candles down, something like this, price moves higher, right? If you think about the averages, right, maybe it comes just above the averages, pauses in a few candles, right, just like this, and then this is the validation, and that might start the move. So on an E, that's how that double MB might look like inside of here. If this is a V, right, so again, in terms of my own trading, if this right here was a daily chart, then of course a 6x multiple or whatever, so a 2-hour or a 65-minute chart, which is what I do, would look like the normal thing you've seen, right? Stage 2 kind of move, big flush out to or below the 20 EMA. That flush out leads to accumulations beyond the line of containment, and that sets up the double MB play long to the top side. So again, these videos, as we're doing the like final building blocks of system or understanding system, are specifically here to tie in everything you've learned so far, to show you that everything you've learned has a aspect to what we do, has a real understanding as to why it works and why it functions the way it does. And looks like this can't be deleted, so I have to go one by one now. But ultimately, it's showing you exactly what you've learned before through multiple lights, so you can truly rely on it when you do this yourself, and know that it's not like just you're just doing randomness, right? And you're just hoping. This is all layered within each other. Every single thing you've done so far is layered. So those accumulations begin to come in. Those MBs get created. We come through the line of containment, or we set up around the line of containment, or we set up higher. So in this case, if this was an E, and price, for instance, moved higher, and then within the line of containment, because now we're on the E, price would be looking a little bit something maybe like this, right? And then it's set up MB1, MB2. This in itself could also act as an entry, right? This in itself could also act as an entry. This could be the double MB, and the MAs, if you imagine them, could have been something like this, right? Price flushes under them, price comes up to or just around the 10/20, sets up the double MB, just that line over the containment line, and sets up the trade. And this could be an example of an E micro right here. And we'll talk about that in a second as well. Okay, let me get rid of all this. Beautiful. So again, you have MBs, double MBs. Sometimes it'll be in the form of a FMB, right? Same thing like where you can, how am I supposed to, there can be a wick on this can. Either way, it can be in the form of an FMB, of an FFMB. We've gone over all those examples, and we'll talk a little bit more about that in well, very, very shortly. But ultimately, the reason that we understand an E-micro too, or that we follow an E-micro, is basically simply for the proposition of more opportunity, because you won't always get, as we know, the double MB. Sometimes price will just go after doing something like this, right? And like the move will just go, right? And in the scenario like this, it might be harder to buy stop either this initial MB or this little area right here where you just say, yep, it's an FFMB. I'm going to buy stop this high of this candle and basically get in under the knowledge this is an MB, right? So let's go back. There we go. Okay, beautiful. So this is ultimately the entire market in one shot, right? You get that stage 2, you get a stage 1. The stage 1 is created by the containment. You have accumulation come in and it runs a supply that's existing, and it creates what you know on the higher time frame as the up move, down move, up move, validation. Inside of that, it's made up of those validations. Inside of that, it's made up of those validations, and it's all layered, right? Now let's talk about why this is so powerful in understanding true trends, okay? We can do an example of something I've traded, or we can do something even on a lower time frame just for the sake of explanation. So I'm gonna get rid of this. This is for video I was making. Let's just go back here and talk about a very specific example of something that I think I traded as an example of application of material. So I'll show you this right now. Within the MentaFX mentorship, within members, not the members portal, within application material, there are going to be videos at the moment. At the time of making this, there's like 1 through 9. You can watch these. These are specific system kind of breakdowns of using the EVC across just realistic action every single day, what it can look like. Some for lower time frames, some are going to be for higher time frames, some are going to be just breakdowns of my own systems, just like the webinars. This is all an area to get a little bit better at that. But ultimately, if we take any area, like let's just imagine, let's start with an easy one. So I won't do a lower time frame yet. Let's just start with something I just recently traded and go from there to really define how this all functions. And let's find something that was generally okay. So this was a generally okay trade where, it created a setup and it went, and then it didn't go a ton, right? It made me some good money, but it just it was like 3RR, 4R, something like that. And then at the moment, it's still going, but it didn't do anything super, super crazy. So let's talk about this trade specifically in conjunction with this idea here. And this should give you the I got it in terms of why the trending methodology is the only and best methodology you can have. So let's go through the same steps. Let's, in this case, just start with an E time frame and work at it from this point of view, okay? So ultimately what happens here is you have a market that on a higher time frame. So white for me is context, blue is validation, okay? So on the validation time frame, which means the daily, we have price go from an accumulation MB, go into a stage 1, which is an accumulation MB, and build an accumulation MB and start coming up out of there. So I didn't trade during this time. I could have, because of the way this was setting up. It's a little bit of a different kind of understanding, but this was a potential trade. Context was an MMB1, but price came out of this accumulation MB and created an MMB1 here, or began to create, right? Going sideways, created the containment line on the rising 5, the cheat code 5. So we're assuming that the 5, 10, and 20 are being bought up, and it's just a simple game of, is it ready? Now, what's actually happening when we go inside of that? There's very little to see here in terms of understanding, but this is how you're going to understand true order buildup. So again, same thing goes down. Everything that we spoke about. There's an initial onslaught of buying. So the way you want to think about this is, there's a button. There's a button. And the composite operator simply has the option to press this button, right? And it will buy. Now, the question here becomes, is the button being pressed at a level that is proving that the composite operator is buying a ton of positions? And in my opinion, based on my own case studying and whatnot, this is very clear evidence that the market is being bought up. The composite operator is clearly pressing that button and buying this. Okay, so clear buy orders come in, and this makes an insane move higher. And then you have selling come in. So I want you to think about this now from the perspective of how other traders might think, how other traders might act, how even the other stuff that you've learned in your history might affect or might have affected the way that you would have traded this. Even think about this without an indicator even on, something like this, right? Because again, when I mark up my charts, when you see everything on the chart the way that I see it, and you get to see the labels that I've put onto my charts, it already has changed your perspective of whatever the fuck you might have been doing before. So I want you to almost be fair in assuming that you can't see these moving averages, that you can't see anything else. And I'm going to walk you through why this is one of the most powerful things to understand in terms of how prices move and demand validation, supply validations, and the continuations of moves. Okay. So ultimately, you have that move up, you have that flush to the 10/20, and what's happening there. Now, again, this line of containment was already drawn in from the daily chart. So remember, at this point, before it ever happened, I want to make that really clear. Before it ever happened, at this exact point, I had that drawn in. Right. Again, there's no like perfect way to do it. There's simply the line of containment. Where is it? In my case, if I had to draw it, it's probably something like this. Okay. I can move it around. That's perfectly fine. And I can look at the E, and for the most part, this does a decent job at containing kind of some of that action. And you can see already after this flush has happened, there is already that accumulation MBs building up for the potential of moving higher. And it's completely valid to take a long through this as a normal double MB setup, right? And then you should be aware that on an E micro, it's likely going to create new entries in or around these areas, which means you might get entries throughout all of this action here, which is actually what ends up happening to me. That's where I end up taking my trade, okay? But I want you to think about the general thought process of most things that you've ever learned in this part here. In this specific instance, this will apply to any time frames, any markets. It's always the exact same thing, but I want you to almost take a step back and think about this from this point of view. So we know buyers, sellers come in. We want to be buyers. What's happening to a lot of other methodologies and thought processes in the world? Okay, what's happening is, if there's something to the left, first of all, there are infinite numbers of people that are consistently looking for the end of a trend to catch the high of a completed move, to catch a reversal, or to catch a bounce, or the potential bounce, or a future continuation. So all of these things together marry into how poor understandings of markets forms, well, it basically dumb supply. That's ultimately what's happening. Like, this is basically dumb supply, but it's always going to happen because it's never changed. This happened for 100+ years easily, and you can see this over and over again across every single market. All right. So what happens here is large sellers or just sellers step in, okay, of some sort. Someone wants to be a seller, and that can happen from any number of other things that you might have learned before or haven't even heard of. And if you haven't heard of them, good, you don't need to know them. And if you ever see them, now you'll know why they are one of the worst things you can do. Some things that people have been taught are things like look for gaps in the market and focus on trading off gaps. Some people have been taught find resistance in the market and look to trade off resistance. Some people have been taught to find head and shoulders or bounces in the market and trade off of that. Right, so they want to go short here, maybe they go long off this bounce. It doesn't really matter. You have infinite number of things like this happening, right? This is always happening. But I want you to specifically think about it in tandem to this specific leg, right? Because that's all we're talking about right now is this specifically. But one of the initial things is that if there's already underlying action, you also need to recognize that many, many people are already thinking, how can I get short up here, inside of these areas, 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 inside of these areas. They're already thinking of ways to make this sell work out for them. So that's step one. You have people, before you even look at just this alone, that are already either looking left and going, oh my God, price needs to stop here and here and here and here and here for the purpose of getting into new sells. Or you have people looking left and seeing that, oh my God, price has never been this high. It's going to be a market that sells off. So either way, whether there's action to the left, that's all, like maybe there's action here, right? Or there's no action to the left and prices come up. There are an infinite number of people, and we can think about it differently. There are trillions of dollars that are constantly looking for the stop, the stop, the stop, go against, go against, go against. It must be the end. Okay, so that's step one. That's one of the multiple things, right? So one is before we even look at this particular moment in time, which is defined by this right here, already understand that there are people where if there's nothing to the left are already thinking there's no way this market can keep going and already are selling, and this is their like biggest confidence of holy shit, selling is coming in, and they are loading up on sells in ways that you can't imagine. That is one of the aspects of supply buildup. There are also people in the event that that's not an all-time high that see a market like, you know, where there's other data on the left, something like this. And they're looking at this data and going, oh my God, we hit a 50% retracement of this leg. We hit a random area in here. We hit a previous peak here. And as a result, that is another aspect or a potential aspect of supply buildup. So either people that think it's at all-time new highs, oh my God, it's supply buildup. They want to sell. They're selling the market already. No idea of risk, no nothing, just selling the market. And you have the people where there is information to the left, where there's other data, and they're going, holy shit, right? I want to be a seller. So that's the first kind of supply buildup that can happen in an area before we even look at the real thing that's happening. Now let's look at the real thing that's happening. Here it is. This is the leg and the move down. Now here we are on an entry time frame. I'm going to step down into an E micro because in this case, an E micro might define it just a little bit better and help you truly understand how much supply is coming into a market that is still being overall demanded. Okay. So the second kind of participant, the second type of dumb participant, let's say, or dumb supply, ultimately comes from this idea. So again, we've already covered the idea of, oh my God, there's action to the left, price is stopping in this area, it must be a seller. It's stopping here, it must be a seller. It's stopping here, it must be a seller. Just so you guys understand, you know, there were sellers here, there were sellers here, there were sellers here, there were sellers at this high, there were sellers here, as this entire leg happened. So that's one thing to understand, right? That is one way that supply buildup is happening. In just this leg alone, that is one way that supply buildup is truly occurring. Okay. Another way that supply buildup is occurring is what I like to call the quote unquote dumb trend follower who doesn't know that he's on the wrong side. And all this means, and there's actually two aspects of this, but this is the second type of supply buildup. So I'm actually going to take a note of this, right? The first type of supply buildup is the market is at all-time highs, can't go higher, must sell. And if it's not all-time highs, then clearly it's hitting some resistance zone, right? And as a result, same thing, right? Must sell. So this is the first kind of individual or institution or hedge fund or whatever you want to call it, because this happens not just to retail traders or dumb traders. Just of course, on YouTube, the stuff that you'll see there, most of it is going to be the things we talk about right here. But this applies to everyone because these choices are made through emotion. They're not made through an understanding of trend or of how trends operate, right? The second type of person that forms the supply line or person that forms a supply, right, are those that basically are somewhat support resistance based. So what I mean by that is if I asked you to draw just simple zones where price bounce, some people will draw something here, some people will draw something here, and some people might draw something like, you know, here. Something like this could be completely fine. It doesn't matter, right? And if I ask them to draw, give me supply and demand zones, right? Some people will say, if I was to be a buyer, right, I want to be a buyer. So sorry. They might say something like, I want to be a buyer here. I want to be a buyer here. I want to be a buyer here. This is how a lot of people think. Okay, so either way, whether you do basic break and retest or just zones, you have basically a second formula of people that are looking at zones below price. Now, the problem with this is unless they're just waiting and doing nothing else than to buy from here, right? What ultimately happens is someone might say something like, hey, because I have a zone here, this market should sell off before it goes up, right? Because I have a zone here, the market needs to sell off before it goes up. Because I have a zone here, the market must sell off before it goes up, which means if for whatever reason they see some kind of pattern of any nature that shows any bit of potential to go lower, even like an example, an anticipation of a higher low, like for instance, in this case, right, you have a clear anticipation of a higher low, like if you're looking at this as a major leg, like something like this, right? If they see something like this is their ultimate, holy shit, the market has broken a major pivot. The market needs to go lower. It's now in higher highs and higher lows, and I'm going to sell this market down, right? And what they'll do is they'll look to sell inside of all these areas here, potentially, to get to these points. So the second person that's kind of involved, or the second entity involved in being part of the supply line buildup, is someone that might actually be correct about direction, but completely wrong about how they're going about it. So because they're correct about direction, they're going about trading the potential downside of the trade. So what ends up happening is when the market begins to sell off, they begin to become sellers in these points, these points, these points, these points, and these points, which means they are now sellers and part of containment of supply that is now in this move. So that's the second type, right? Waiting for a zone, and even worse, selling into a zone in a buying market. Okay, this is another way within which supply is basically created. Another way in which supply can be created in the market. This is how someone else is basically getting involved into new supply. The third type is what we can call the potential for supply, which ends up becoming supply. So the way this works is it almost takes it to the next level where someone doesn't recognize where they are or where they are in a move in this case, which is everything's in stage 2. We're in an MMB on a bullish chart. So across the EVC, we want to trade bullish. Someone on any given day, maybe on a 2-minute, a 5-minute, whatever it might be, maybe looking at this price. And what do we say? The potential for supply. So they might be looking at price on this given day or the next day, and they might say something like, okay, on the next day, if price gets to this zone, I will continue selling. If price gets to this zone, I will continue selling. If price gets to this zone, I will continue selling. So they might already have sell orders placed at these points, so they can sell into the action, right? Sell into the market, or they might be watching for these points for the market to show them sellers coming in, right? So they might wait. Sellers will, of course, come in because sellers always come in at any random zones. They'll sell and they'll get taken out. So again, just to demonstrate, I don't know, like maybe they will, but price comes up, starts selling. These are those sellers getting involved. Those sellers might start even making money and they get ran. They get involved again, they start getting ran. They get involved again, they start getting ran. They get involved again in these wicks, they get ran. They get involved in these wicks, because these are all time frames, remember, right? So all these time frames are always happening at all times. They get involved, they get ran over and over and over again. So that's another form of where sellers are getting ran, where they are, again, watching everything to the left of the chart inside of this containment that's happening and getting involved in new supply, right? Because at the point, they think that a true bearish market has started. So the only option is to create supply. So the third kind of person that's responsible for the containment line, and even beyond the containment line, is those basically looking for the potential for supply. Okay, which leads us to the fourth type. Let's go back to the 65-minute chart, so it's not all over the place. The fourth type, so the potential of suppliers, all the sellers that are already starting to get participated in the move. The fourth type is basic supply. If you want to think, like, again, these aren't perfect words, but I'm just showing you how selling actually truly happens and why nothing will ever change, because these are all emotional-based choices a lot of the time. Another way that it can happen is through the fact that because of how the initial legs form, people will be looking at patterns like, hey, I can sell off this point. Hey, I can maybe sell off this point. So it's basically the same thing as the third. It's the potential for supply. So we'll even leave this one out, okay? The fourth type are those that might even, the potential of supply again. So like maybe some new selling comes in, something like this, right? At this point, a lot of people sell on this day and they get ran for that as well, okay? So ultimately what happens, and the way I want you to think about this, is that a huge and an almost infinite number of sell orders stack up into this action, okay? Even more are ready to stack up because they have the potential for supply, are ready to stack up at places above, which means as price moves higher, there are already people that were waiting to stack into the market, now stacking into the market on that potential of supply, right? You have the initial supply, the people that don't believe it can go higher or that they think that it's at some resistance zone for whatever random reason, right? Something like this. And then you have, of course, the quote unquote liquidators, or the people that think they've understood that the market is ready to finally reverse. So what you have is the high and low pickers, right? So the second price moves to a high or above a high, you have another infinite number of people, so the top pickers. Okay, you have an infinite number of people that want to sell into this market. So again, you have a ton of sell orders that are also placed or ready to be placed. So you have also a potential for the top pickers at these points and above these points. So as price, of course, pauses, up here and kind of moves down, those are new sellers already looking to get involved. Okay, they're already looking to get involved. So again, I want you to think about all this as the different kinds of sellers that exist. The second one of these moments kind of happen. This is how that supply gets built up. So the containment is built up by all that initial selling. And because the containment's being built up, the areas above and the areas above will create new guaranteed supply from those initial people already. And even more, right? Because there's people that specifically work within assuming this is how markets move, so they want to become sellers too. Okay, and they want to get into selling because they haven't learned more than that. They don't understand that a trend is a trend is a trend, right? They can't get over the fact that this action here does not matter in terms of the fact that price is here because of the model and the cycle that it's now moving in. That's very hard for a lot of people to do, right? They see this, it's like, no way it can go because clearly, there's price here and it'll stop it right there. So this will be the stop. And this was that initial onslaught of selling too. These are the people that think head and shoulders, resistance, blah, 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 blah. So again, when you see this shit online, know what's actually occurring, right? So you have the top pickers and the top pickers will start selling here or in areas above. So these are all potential sellers. And now something else that's really, really important in terms of sellers, this is the fifth, is you have the martingalers / average down traders. And this is very, very important because of all these sells, in many cases, it could be even 50% of them, are people that are not going to want to hold a loss and will actually have trades set up that will average them down so they can hopefully get out later. This is fucking crazy, but this is how it works. So that means that the seller here who got in, but it didn't work, and now it's going against him, actually also has sell orders that might be larger than the prior sell order set up here, here, and here. So hopefully he can double his position and then hope, and then it might not go. So he doubles his position, then he hopes, but it might not go. And then he doubles his position, then he hopes, and then it might work, and he might get out with a break even, or he might make like a little bit of money. That's perfectly fine. That can happen. But there are traders like that, which means if that individual has orders like this, well, of course, you have the natural propensity for an almost infinite number of participants in this market to also set orders similarly based on their own sell orders and their own metrics. And on top of the people that are martingaling potentially, you have the average down traders, right? The martingalers or the average down traders, where they might double their positions or they might just get into new positions to make their entry price, instead of having an entry price that's here, they might get into a new position here. So their entry price is around here, which means that if price comes back a little bit, they could get out at break even or make a little bit of money, a few cents or whatever, right? Again, very poor RR management, no idea what the fuck they're doing, but it sells courses and it sells signals. And a lot of people think that they've learned something from it, okay? So again, every red thing is a order or a potential order on the sell side, which is a very, very important thing to remember, right? And these might not be as high, you don't know exactly how these are happening, but you don't need to. It's not part of it because if once you understand this is the case of how markets move, you stop thinking about anything regarding price might stop and do this and this and this. You start thinking in cycle, momentum, trend. And you get to a point where you're like, yes, trend. Yes, it's there. I want to trade it. I make money. I want to trade it. Right? I want to trade it. It's not clear. Okay, unlucky. I wait. I want to trade it. I make money. And we're going to talk about all this over and over and over again. I'm going to show you all this, and you're going to get access to it in a second. But everything comes from this. It comes from the floating supply that gets built up. It comes from the supply buildup that happens with the people that can't believe the fact that new supply is coming in. And that's a starting staple point of true supply buildup. So once that supply is accumulated, and that accumulation has moved into accumulation and moved beyond the point of containment, where literally that supply couldn't make the price go lower, what now begins to happen is the buyers, the large composite operators, because again, what we're doing is we're looking for the trades that are true composite orders, right, that are truly large. The composite buyers that have bought through all of this, right, that have bought through all this, that are now making a fuck ton of money on this move higher and have bought enormous positions through these moves higher. And as selling comes in and they start to buy up all those orders inside of here, and it gets through the point of containment, right, and huge buying comes in, that's when all the prior, you can almost think about this right here, about maybe 80% of the orders that might have been some of these right here start to get out of their sell positions. So because people get scared. So over highs, they get out of sell positions. So like this high, they get out. Over this high, they get out. So all of a sudden, the sellers, because they're getting rid of their positions, become buyers, right? Because to sell, if you're in a sell, right, what do you have to do to get out of the sell? Well, you have to buy, right? So for instance, if you sold me a watch, right, and then here you sold me like this watch right here. Oh my god, it made a wrist stain on me. If you sold me this watch for like $100, okay, and actually this is a bad example, but very simply, if you're in a sell, you have to buy back, right? If you want to get out of the position. That's ultimately it. So ignore the thing I just went through. And what's interesting is all these sellers that have stop losses, so all these sellers that have stop losses above, guess what they become when the stop losses get hit? They become buy orders, right? And as a result, you have stage ones that become beautiful stage twos. And in the event of sustainability, or even the buildup of new supply or dump supply or whatever it might be, you can get extravagantly beautiful moves, okay? There it is. All right, over and over again, it's the same thing. Okay, so once you truly understand that this is kind of what cultivates the entire market, you start realizing that everything is basically this setup, and everything is through the purpose of trend continuation, trend continuation, trend continuation. Now, trend doesn't always continue, and trends don't always maintain themselves, and they're not always there for the momentum cycles. But when they do, you have basically the highest propensity for earning potential. And again, you don't have to listen to me in regards to that, because there is direct proof that the richest traders of all time that have at least been on a personal scale, but also institutionally, have been trend followers, and they just follow the trend and they buy into trends, and they don't play these games of like, oh, but what if it just gets to this perfect point and gets right to the high and we sell? They don't play that fucking game, because they understand the game is just simply let the emotional freaks make the dumb choices, let new accumulation come in, we'll buy up the dumb freak energy, and that will create brand new moves, because then it will be incentivized by insane buying from every party, which means the composite operator ends up being the overall buying entity. And in this case, if in a bullish market, you get a bullish move, right? So I hope that made sense. So that is why kind of the supply line exists. It's an understanding of how truly, and not truly, but of just what's happening inside of that point, right? And this will happen on any V, right? So if your V is a 1 minute chart, which is what I did for some of the examples in the application of materials video, right? If the 1 minute is your V, let me find an example of some trades I took that was like whatever. Sure, like even this little trade, right? It's the same thing occurring, even inside of this area here. It's the exact same thing occurring, right? What you have is a market that has proven bullishness. Someone has hit that buy button. The V has then gone into whatever. It played around a little bit here, then moved higher, and it went into a VMMB1 or MMB2, however you want to kind of view this, because you can have MMB1, and then this is all MMB1, or it breaks down. You can think this is accumulation MMB1. So the second this MMB1 gets created, and then as a result, you put in your supply line, the same thing is now true of everything you just heard. So this high, right, kind of acts as that exact same thing that you see here, which is that if we look at this on a lower time frame, again, doesn't matter what time frame we're on. If we look at this on a lower time frame, the same thing is present. You have the buying, the selling starts to come in. The selling is almost quote unquote dumb. New selling builds up at those levels. Selling builds up. The containment gets taken out. Those sellers want to become buyers now, or they don't become buyers, but they just become buyers because they get out of their positions. The already existing buyers are in the positions. The buying starts to occur. The buying comes through. The sellers are getting completely wiped. It makes its move, and there you go. You have a play out of the exact same thing we've discussed over and over and over again. Right. So again, if I go inside of here, you're going to see that same thing occurring. So once you understand this, you truly almost pull away from looking elsewhere, because you realize where and why so many are going wrong. So many are going wrong. You understand how when you hear things like, when you see highs and there's a high, you need to make sure you high, and then you take out the right. You stop caring about that. When you hear people say something like, you have a structural move, and if you get a breakdown, you got to make sure you start selling here. You go, wait, this doesn't really make sense. And you hear stuff like, when you see a high and then it comes down to something like this, you got to make sure you sell here. You're like, but wait, if we're in a bullish market, or if the cycle is bullish, like if the cycle is like weird, then maybe this could work. But if the cycle is bullish, then this is all part of an accumulation, and very likely, if you just think about tools and the way that money's coming in, like, isn't this more likely? And then the person that's selling like this is just kind of getting fucked. Yes, and yes. Right? Oh, but there's like this crazy move that happens, and the price comes down, and then it plays around stage 1s, and then it starts to stage 2, and then at MMB1, MMB2. You already know what you want to find here. You already know what this asset looks like. You already know what this asset wants to do. And then if someone teaches you, hey, there was a big resistance here, you want to make sure you watch that. There was a big area here, you want to make sure you watch that. You start looking at this, you're like, why does all this information, or the way that people are processing this information, matter? It doesn't make much sense. What matters is the cycle we're in. The cycle happens based on the orders that are coming in based on that time frame for that given cycle. So in that case, right, when we have orders enter the market in a specific way, and then it begins to, let's say, go sideways or whatever, or go sideways in here, why would I look to sell here, or here, or here, or at any other point on the left for any random reason, when there's an existing EVC delivery of a momentum cycle? There isn't. So now, no matter what prices do, right, you have basically a blueprint for what a market does in terms of a setup, at least on the long side, and just flip this for the short side. But it's the same thing, right? It would just be the demand buildup or whatever, right? Because it'd be dumb buyers into supply. But this is the blueprint. This is the blueprint of everything that I've done, everything that I do, of everything that I understand, right? There's your down candle and your up candle. And we've already spoken about this like 5,000 times, but now with a little bit of added information, with a little bit of better added information in terms of technicals and approaching and applying it to actual charts, this understanding alone, and we're going to go even deeper in a second and talk about the timeframes within this and what's actually happening there. This understanding alone should push you over the edge and go, got it. This is why I don't need to follow any of this other shit that I've seen before, because now I quite literally understand why it can work for some people at a smaller level, but I understand why I would want to follow the trend on any given move, and I know how to do that on any asset in any time frame. So you can literally sit around and wait for things in the world to happen, and let assets do whatever the assets need to fucking do on the time frames that you prefer. And when the things that you know should happen for big market participants to be behind a move happen, then you can be a part of them. And you can take your edge out of the market. You can put your money to work. And that can be as long as months long trades with hundreds of millions of dollars, or year-long trades with hundreds of millions of dollars, or it could be as easy as 2-minute long trades off of 10-second entries, 20-second entries off your like 100K account, $5,000 account, whatever it might be, right? There's no difference. It's just a game of allow the cycle to show itself and trade the cycle with the understanding of where most are going wrong, but also with the simple understanding of what prices need to do for them to actually play out and for you to get behind them. and you know exactly what you need to look for across 3 different time frames that you're able to tie together into one coherent, cohegent system. All right, we'll talk about this right here after. You guys can read it if you want right now. It's very simple. It just explains this, but it jumps into the E micro, and then we're going to move into basically the next building blocks of everything else. All right, let's do it.